Welcome back, everyone. Cary Williams, Portfolio Manager with North Road Investment Counsel here, joined by my colleague, Marshall McAlister. Second part of our 2024 year in review. Looking forward now through 2025 and beyond. Marshall, this is the most exciting part for me. I know that you and I have spent a lot of time working on these trends. Fill us in, anything you want to add before we get going here.
No, looking forward to showing some of the slides that we've created, and should be an interesting conversation.
Awesome. So I'm going to share our slides here just to give everybody a bit of framing for today, Marshall. We're going to walk through a bunch of trends that we're seeing based on some questions that we've had from clients so far this year. We've added a slide today. We're recording on January 28th, and we've added a slide about NVIDIA because we've had a big change in markets yesterday. So we're trying to keep this as up to date as we can and get it out to you as quickly as we can. Let's dig right in because, Marshall, we're going to try and keep this under 30 minutes, and it might be a little bit of a stretch because, as you know, I love doing research and I love building slides and talking about markets, and I may have gone a little overboard today. So let's get going.
Right on.
All right. Let me start off, Marshall. I want to talk about the AI revolution. This, I think, has a huge impact for what we've been seeing the last couple of years and could be a major trend moving forward. You and I have started to get used to using AI tools. We've been talking about it internally and how we can provide a better experience with some of these tools. It's having a huge impact. I want to just talk for a couple of minutes on what's been happening the last few years and why it's such a big deal.
Yeah, and I would say people need to pay attention. This is not going away. This is only becoming more of a significant factor in day-to-day life in 2025.
Yeah, I agree. I'm really excited by this. To be frank, I'm also a little nervous. I think this has the potential to have a huge impact on lives moving forward. When I think about my kids who are in junior high now, this is going to be a huge part of their working life. And so let's take a few minutes just to talk about what's been happening. This chart that we see here, I think, tells a phenomenal story in a visual chart. So this is, 70 years in the making in artificial intelligence. But the last few years in this chart, let's say 14, compute has just gone parabolic. It's into the hockey stick portion of how we're training these models as far as the amount of compute being used. This just makes these models more and more powerful and more relevant in our lives. Why is this important and valuable, and how do we understand this? This chart shows us how AI models are performing in comparison to average human performance in a bunch of different areas. And I'll draw attention to this group over here, this blue and green line, where you can see handwriting recognition and speech recognition took a really long time for AI to catch up on. That being said, look at the right side of the chart. This section in the last few years is just almost straight up. We're talking months of benefit here, of growth from AI to get to human performance. These are certain hand-picked, cherry-picked areas, Marshall, but I think it really does indicate why this is becoming such a topic and also an interest in markets.
Absolutely. And taking in a massive amount of computing power, which then requires energy to compute these models, and it's also something to take into account.
Yeah, absolutely. This may not last forever as far as that hockey stick perception, right? At some point, resources become constrained in building, and that's some of the chatter that's happening around AI development. But I love this as an example as to how this is impacting our everyday life. So the future is here when it comes to self-driving cars. This is a Waymo car in San Francisco, in Phoenix, in Austin. Driverless cars. Last year, Waymo did 4 million miles with no driver. That to me just blows my mind. It's unreal.
Yeah, unreal.
And it's been safer, if you can believe it. So stats right now are showing lower airbag deployments, lower injury-causing crashes, police reports, insurance reports. Grain of salt here. This is in Phoenix and San Francisco. Not a lot of snow there, as we know in Edmonton, but this is getting better and better. And AI is only going to make these types of advances more and more capable and better as an experience for humans.
Have you been in a self-driving car?
I haven't, and honestly, I'm looking forward to it. What do you think?
I've had friends that have, and they tell me the experience is amazing and also a little bit frightening.
Yeah. Yeah, being out of control, like you have no control where this thing is going. That's one of the lovely things about driving, right? Is that you feel in control. Yeah. All right. So what does this mean for markets? Well, I will go on the record now, Marshall, to say I feel like we're in a full-blown bull market. We're running with the bulls. Last year was a phenomenal year for markets as far as returns. What does it mean when we say we're in a bull market? Well, if we look back to 2022, we had a significant downturn in markets. It was short-lived, so to speak, but we saw pretty significant drop in the S&P 500, eventually in the TSX. And from the perspective of bear markets, the opposite, I would say that was a bear market that we went into, even though it turned around pretty quickly and we didn't see an economic recession shortly after that.
Yeah. So let's see what happened after September of 2023 now.
Yeah. So moving to October 2023 to the end of last year, just phenomenal returns for markets moving forward from there.
Yeah.
So let's surmise a little bit. Let's be a little predictive, potentially based on some data here around what markets look like in bear markets. One of the questions I often get, Marshall, after we've had a year like last year is, yeah, but doesn't this mean that I should be more cautious and afraid moving forward? Mm-hmm. And I would say history around bull markets, at least on average, does not indicate that. Bull markets tend to be multi-year bulls where returns are not always smooth, but provide us with returns and rewards for being invested.
Yeah, there you go. I mean, the distribution around negative returns and positive returns, they're going to be, not perfectly consistent, but I mean, the likelihood that we could experience a negative return, it doesn't evaporate just because we've had a positive return and or a negative return the following year, right? Markets tend to reward patient capital, and regardless of last year's return, we can still hopefully see positive returns in the next period.
Yeah. So on screen here, we're seeing average returns for each year of bull markets going in the S&P 500 going back to 1950. We can see that this isn't always a bumpy ride. That third year, investors on average were trying to figure out what these markets look like. But we can see that, to your point, being patient rewards investors. Less consistent data as far as the number of data points is around what happens when we have two back-to-back years where it's plus 20 in the market, which is what we've had. And I find this chart fascinating, Marshall. There's not a lot of data points here, so we can't really take this as gospel, so to speak, but we can see once in the 1950s, S&P 500 had back-to-back 20-year returns. Once at the beginning of the 50s, once in the middle years, once in 1970s, once in 1980s, and then fascinatingly for me, right here, we get the .com boom, where we get back-to-back years of plus 20%. So is this exactly like the birth of the internet as far as AI? We can't say that, but could we see good markets moving forward? I mean, there is at least one instance in the past where this happened, and it was a technological revolution that caused it. Mm-hmm. What did I miss there, Marshall? Anything you want to add?
No, I think good markets don't necessarily mean bad markets are coming. And if we take a long-term perspective, we can continue to hold through these multi-periods that we need our clients to hold through.
Yeah, absolutely. I also think one of the things we need to be careful in bull markets is FOMO, fear of missing out, and then trying to chase returns. So I put together an explanation on this that is a little cheeky, but is one that I quite like. So markets did well last year, but maybe we should have owned Bitcoin. 150% return for Bitcoin last year. Does that mean we should own Bitcoin? A number of our clients have told us in the past they're not interested. Some of our clients are asking about it. Maybe that's a solution that we should be looking at. I had an instance recently, Marshall, at a family dinner where somebody said, hey, I heard from another person that I know that their financial advisor put them into Bitcoin. They made so much money last year. Super happy, right? Yeah. My response would be like, yeah, there's some FOMO there. What about NVIDIA? Should we just be in NVIDIA at 171? We would have done way better than Bitcoin. Yeah. What about AppLovin Corp? Up 713%. Marshall, do you know what AppLovin Corp does?
No idea.
No idea. I don't know either. No. Gene DX Holdings. Maybe it should have been Gene DX Holdings we should have been in. 2,690% return.
Yeah.
Yeah.
No idea what that is.
No idea. No idea, right? So my point here is I'm cherry picking, but my point is just statistically, if we have millions of investors and lots of different options, someone somewhere is going to own these and is going to brag about it. We need to be really careful chasing news or anecdotes as far as our returns. Because at some point, things don't become quite so easy and quite so obvious. I love this magazine cover, Marshall. December 27th, 1999. Time Person of the Year, Jeff Bezos, Amazon.com. E-commerce is going to change the way the world shops.
Yeah.
And it sure did. Right? I get regular boxes from Amazon as I do from other e-commerce sites. But that doesn't mean it's a smooth ride. Right. 6 days after this, Amazon went from more than $4.40 for their stock down to 30 cents about 18 months later. A huge drop in their stock price and didn't recover for almost 9 years.
Yeah, that's a story that's often forgotten in terms of how valuable Amazon has been in the capital markets.
And not obvious that they were going to become the company they've become, right?
Yeah, that's true. It seems obvious now, right? I mean, they're so prevalent, but not 10 years ago or 20 years ago.
Yeah. So part of that, Marshall, you and I would say is expectations versus price. Price is the great equalizer. If everyone has high expectations for a stock, the price gets driven up. So on this chart, I'm going to draw people's attention to the left side where we can see the dot-com boom and valuations for the 10 largest companies or top 10 companies at that point, as well as where we're at today, which is this current spot right here. Okay, so we can see that our valuations for those 10 largest companies that we talked about in our 2024 year in review, where their returns have been just fantastic. The Magnificent Seven is an example, being one of the phrases we've used. The valuations may not be as high as the dot-com boom, but they're still very elevated.
Yeah, absolutely. You see the average is just over 20.5 times. And these are closer to 30 times, right? So that's a significant valuation premium.
For sure. And companies have to grow into those valuations or price takes a hit.
That's right.
Right. And so big expectations can often mean a challenge for companies when those expectations might not be matched. And we saw that this week. I referenced it in the beginning of the video, but NVIDIA has had a really interesting few days. So this chart shows the last 5 days for NVIDIA to mid today, January 28th. And we can see that there was a massive change in the market's expectations for NVIDIA yesterday.
Yeah,
fell almost 17% because an AI competitor came out, DeepSync, that was cheaper to run without using apparently the NVIDIA's top chips to do it. So markets are repricing their expectations for NVIDIA's sales profitability and opportunity moving forward. Anything you want to add there, Marshall?
No, that's good.
All right, let's keep going. Other FOMO areas. Here's a cheeky title. Welcome to the Privates Party. We're going to talk about private markets. Marshall, you and I see this all the time. We talk to other advisors. We are getting, I'm going to say, inundated with opportunities asking for us to invest with private equity, private credit funds right now.
Yeah.
Let's talk through what that might look like.
You bet.
Despite this, what feels like a rush to recognize privates for individual investors and families, Jason Zweig, columnist with Wall Street Journal, had this headline in December: "You're invited to Wall Street's private party. Say you're busy," which of course is a fantastic headline, right? It's cheeky. It makes me laugh. But in this article, he went on to talk about the challenges around private markets. And we've laid out a few slides here just to talk about why private equity firms may be trying to get more of their investments into the hands of families and individual investors.
Yeah, very good. So here we see private equity fundraising tailing off. These firms are not able to get capital as readily as they could a few years ago. And now this capital raise is coming into the private client world. And that to me is a bit concerning because oftentimes the great deals go to the institutional investors. The average deals might be available to private client investors, and that's something that we need to be careful of.
Another side, Marshall, that I find really interesting is recently private equity exits are down quite a lot. So exits mean they're getting out of some form of investment, having money come in from selling off a company perhaps, and having capital potentially returned to investors. And that's way down the last few years. So these institutional investors who have been in private equity for a long time, as an example, may have less capital to reinvest in new funds as a result of not seeing cash flow come through. And potentially the returns are going to be lower because they're being postponed until over the years until cash flow can be created. In addition, we're seeing multiples recently compared to in the past go up in private equity. So this chart shows what are called LBOs, leverage buyouts, and the multiples have gone up from the 90s. So lots of the materials that we're seeing from private equity firms that have long histories are talking about how well they've done. But we know that, at least historically in most markets, as money chases the same companies and valuations go up and higher prices have to be paid, that means lower expected returns for the future. So we should expect that I would say we should expect that historical returns may not be as high as future returns. Or pardon me, the other way around. Future returns may not be as high as historical returns. This is one indicator that I found really fascinating, Marshall. So this looks at BlackRock and Blackstone. BlackRock being the large money manager, provides exchange-traded funds through iShares and lots of low-cost passive investments. Blackstone being one of the largest private equity fund providers. On the right-hand side, we can see the assets under management. BlackRock being 11 trillion, Blackstone being 1.1 trillion approximately, and the revenue for each. And despite BlackRock having almost 10 times the assets, their revenue is only about 3 times larger.
So a huge fees being generated in the private equity space, and that is a distraction to expected return.
Yeah. If I was running a private equity firm, I would absolutely be wanting to get more money into my firm to invest and collect these high fees, right? And we saw that last year. BlackRock did a significant purchase of a large private infrastructure money manager. So even BlackRock is saying, oh, well, we need to also be into these private markets and can drive higher fees for our shareholders. All right. So all of that to say, well, we've remained skeptical on some of these opportunities. Let's sort of take things at face value and say maybe private equity, as an example, is worth investing in. How much would an investor want to have in private equity potentially, and how would we even start that conversation and that analysis? So Marshall, I like this idea. Basically says, let's look at how big private equity is compared to the total equity market. This came from a large private equity fund manager out of the US, and we can see that they feel US private equity as a percent of total equity market is about 10%.
So that's comforting to me, because the portfolios that we build that have U.S. exposure is capturing a massive amount of the capitalization and like the business value of the U.S. market. And if we don't get that 10%, maybe we're going to be okay.
That's right. And if you wanted to go into private markets and you wanted to own the market rate or the market percentage, 10% of your U.S. equity exposure, as an example, is a very small number if you're well diversified across the globe, right? And so to your point, making the decision not to be there is probably an okay decision, until you find maybe better options that we are seeing, as an example, in passive instruments where fees have been driven down and transparency is there and some of those kind of things. So I think being patient on these vehicles is a reasonable decision.
Yeah.
All right, let's get to the topic du jour. I'm hearing from clients many questions on the news, Marshall, about tariffs, changes in politics, all those kind of things. So let's dig into this a little bit.
That's right. There's a little bit of weight here, isn't there?
Yeah. I thought this chart from Pew Research Center was fantastic, Marshall. if folks are feeling like life is very uncertain right now and the news is very heavy around politics, there might be a reason for that. There are many, many, many countries across the world in 2024 who had elections. And so some of the most populous countries, right? We've got India in April, we've got Indonesia in February. Mexico has a special place in your heart, Marshall. The UK is in the news a lot. Japan is there. US is there. As far as France, as far as markets are concerned, there's a lot of markets that have had elections this year.
Absolutely. Yeah. A lot of change.
We also see, at least in the U.S. Perspective, that the S&P 500, going back to 1926, has continued to provide not bump-free returns, but at least positive returns, no matter who was in power over time. So there's no way to predict if a Republican or a Democrat is going to be better for stock market returns.
Yeah.
Getting really specific, because we now have President Trump back in the White House. The last time he was here, markets were okay with him being president. That might not be directly related. It might just be that the economy was doing okay and markets were rewarding companies that were profitable and doing well. But it was not negative. And we had tariffs through some of that period. And we had a lot of what felt very chaotic news coming out. And that might be par for the course in this term. It does not necessarily mean that markets are going to be negative. It just means that there's uncertainty, and we may just have to sit in uncertainty as a form of, for lack of a better term, emotional risk as we hold our portfolios.
Yeah, that's right.
One of the things that I'm also getting questions on, Marshall, is inflation. So with some of the chatter around the U.S. politics being tariffs and immigration, I wanted to touch on the economic case that's being talked about, or potential outcomes. Inflation might be one of them. I don't want to minimize the feelings that folks have around these topics by any means. There are real lives being impacted by these decisions. But from an economic perspective, one of the potential outcomes is inflation comes back. And I think tariffs and lower immigration can contribute to that.
Yeah, the tariff could likely just increase prices in the purchasing market, which then is a direct connection to inflation, making cost of living even more challenging for the lower earning parts of economies, that being Canada, even United States. I'm not sure we can find very many economists that would support the idea of adding tariffs between countries. It adds confusion, it adds frictions, it allows less efficient producers and businesses to thrive when other businesses should. It's just not good.
Absolutely. And from an inflation perspective, if it does have the impact of driving up inflation because it's an additional cost, we have seen historically that the few moments when we've had inflation, it's been sticky and spiky and variable. So what we're seeing on the chart right now is the 1940s after the Great War, and we can see that there were 3 spikes of inflation. Very similar chart for the 1970s, multiple rounds of inflation. So the idea that inflation is conquered and government can do whatever it wants and we don't have to worry about inflation is not entirely accurate to the historical record. There's not a lot of data points here as far as runaway inflation, but it's good to note that it's definitely a possibility, and portfolios that have some form of asset that can deal with inflation over time are very helpful.
Yeah.
All right. I buried the lead on this whole presentation though, Marshall. Let's get to the punchline, which is predictions for the future are hard.
Yeah, absolutely. It never changes.
It never changes. I love this chart. I love it because here are some of the biggest financial institutions giving their predictions over the last few years across all the brightly colored lines. And then we see the actual return, and it's not even close to what's realized compared to predictions.
Yeah.
Right.
I've been in the chair now I've been doing this for over 20 years. There hasn't been a new portfolio that I've implemented into an investment model that I haven't felt concerned about the next few quarters. Like, it's every time a new client joins, I'm thinking, oh shoot, I'm frustrated about this timing. But I've learned to not do anything about that. I'm just like give myself the permission to be wrong in the short term because thankfully we've been rewarded with great returns over longer periods of time. And really that's what we're trying to focus on, like getting rid of the kind of the error maximization of predictions to a more humble approach of like let's own many assets, let's not be bold, let's just diversify and structure and make sure our rebalancing is done in a systematic way and not an emotional way, right?
Absolutely. And I think that's a good chance for us to segue into a few recommendations here, Marshall. And typically at the end of these kind of presentations from other investment analysts, as an example, there would be, go and buy this company or go look at this, go do that as far as investments. Our recommendations are totally different. Right? Number one, you just touched on it. Like, let's be humble and just recognize that in chaotic times, the future is uncertain and we have no idea what's going to happen. And just be okay with that. Right? What that means is be non-predictive, own lots and lots of assets, diversify massively, way more than most people think about all over the world because we just don't know. And tariffs are a great example. I've heard numbers from 2.5 to 25 to all over the place. I have no idea what's going to happen with tariffs, who's going to win, who's going to lose. Let's be diversified.
And either you admire or you despise Donald Trump. His involvement in the White House is not going to stop capitalism. It's not going to stop commerce. You and I aren't here to give our opinions about his personality or his leadership style. He's in charge for the next 4 years, and like it or lump it, this is what we have to deal with, right? So, or this is what we get to deal with, depending on how you see the world. We are not going to be abandoning the U.S. equity side of our portfolio for clients that despise them, and we're not going to be adding extremely high value more equities in the United States market for clients that like them. We need to stay even.
That's right. Focus on managing risk. Focus on risks you can be okay handling even when risk is realized. Plan this ahead of time and be systematic. Right. Yeah. That being said, Marshall, one of the things I've told some clients is it's okay if you feel really uncertain to have a little cushion. It's okay to keep a little extra cash, right? That can help you, cover an extra month's expenses, right? That's a reasonable outcome. Selling all of your investments and going to cash, I would say that's not the same case. That's an example of allowing fear to drive your outcomes and not focusing on long-term goals on that end, right? Okay, let's keep going. What else can you do? Let's focus on what you can control. We mentioned this in our last video. One of the things that we can control is the other risks in our life. So our firm feels that digital risk with our online lives, which are going more and more online, is a big risk for wealthy families, for small institutions. We should be trying to button this up. So to all the folks that are watching, if you haven't already done an assessment with us or done the short version of that, the digital risk quiz that's on our website, 10 questions, 60 seconds, go and take it and get an idea of what your digital risk in your life looks like and how you can make it better to reduce potential hacking or fraud or negative outcomes.
Absolutely. Your life will be changed after going through the assessment and the work that we're doing here at North Road. We hope for the better, of course, but it's going to take some effort and some attention on your part. We're putting up on the screen now the QR code where you can use your phone, scan directly into the quiz. From here, take the quiz, get prompted on the areas in your life that you need extra support in, and that'll come back to our office, and we will then have a report to use to start off our assessment of your digital risks.
Awesome. So on that regard, Marshall, I would say also that this is publicly available, this quiz. So feel free to send it on to friends, family, people you care about that could use a little extra help in understanding what digital risks look like. You can forward on this video, have them watch the whole thing and let them know to stay to the end, or you can just send them to the website and check that out. And that's a wrap. How'd we do? You know what, Marshall? I think we're under 30 minutes. So I'm high five. I'm proud of us. That's pretty tough for you and I. All right.
Awesome.
Without further ado then, thank you. And special thanks to Josh Mraz on our team who made all those slides possible. He's done a phenomenal job in making our life a little easier and a little more beautiful. So thanks, Josh.
Thanks, Josh. Appreciate it, man.
All right. Thanks. Bye-bye.